Welcome to a CNBC Africa special. As always, my name is Arnold Kwizera, coming to you from Kigali, Rwanda. And today, in our final conversation this year with the governor of the Central Bank of Rwanda, Mr. John Rwangombwa, we're going to be speaking all matters finance, what we should expect going into next year, and a bit, we'll touch a bit on the economic recovery of Rwanda. As always, you can tweet us at CNBC Africa, or you could tag me directly at The Real Kwizera to be part of this conversation. Thank you for joining us and for making the time, Governor.
Thank you. Thank you for inviting me.
Quickly, you released results last week, and that's the MPC report, the quarterly report. A quick summary into the financial performance of Q3 of Rwanda, please.
Yeah, I think the Q3 performance shows a bit of good recovery on the economy and going to the financial sector as well. So when you look at, starting with the economy, so we track what we call the composite index of economic activities. At least we see a positive growth this quarter, that is at 6%. And so that shows signs of the economic recovery, at least from the first half of the year. Not yet sure of the actual performance of the economy. That will come from the Institute of Statistics release, maybe later this month or so, or next month. And we continue to see good performance of the banks extending credit to the private sector. Not as good as last year, but at least it gives us a good indication that the economy is on a recovery trajectory, because we see the credit to the private sector, the outstanding, still growing at more than 17%. So that's a good sign of performance of the financial sector. Though the new loans, the new authorized loans, that was expected because of lower demand, especially in the the second quarter of this year. Overall performance in the first 9 months, we saw a reduction of around 8.2% in the new authorized loans. But when you compare the nominal amount, 2018, it's much higher in the first 9 months. So it's already good signs anyway. So yes, we see positive trends in the economy in general, but also in the financial sector in particular. Maybe to also say that we are happy that we have enough liquidity within the financial sector. So so they are ready to service any needs of their customers, and they're ready to extend new loans to their borrowers.
At the beginning of the pandemic, let's take it a few steps back, in March, when Rwanda announced its first cases, you had to take drastic measures in April as Q1 results came through. And one of those measures you took was the lowering of the key repo rate from, by then, the 5% to the 4.5%. Now, the reason you gave us then was you wanted capital, to increase capital outflow and liquidity on the market. 7 months later, do you feel this has been achieved, or is it too early to judge?
I think maybe capital flow would be a strong word to use here. Our main target is the financial transactions, especially on the money market business, that at the end of the day translates into the long-term lending by the banks. So one I have already indicated has been good performance on the side of the credit to the private sector. That is linked to the decisions of the MPC as well. So apart from the growth, we also saw the interest on average interest commercial banks charge their borrowers reducing in this year to in the first 9 months, which is linked to that decisions of the MPC as well. So reduced by around 14 basis points to 16.31. The other big indicator we see is the operations of the interbank market. I think this is the main indicator of our transmission into the market. The lendings or the transactions between banks increased in the first, since we took that decision. That is, when you look at May to September, it increased by 41% in terms of the transactions between banks, the interbank market, and the rate also reduced. So that gives us indication that our decisions being transmitted into the market. So the quick ones are the money market, especially the interbank market, and then that at the end of the day translates into what happens in the lending market to the borrowers to the commercial banks.
Another thing to look out for in the statement that was released was inflation. Inflation stood at 9%. Now, there's many people, there's reason for concern at this moment. Is there really reason for concern at this moment? Should we worry?
No, I think we've gone beyond the period of concern. Yes, we had one can call it moderate high inflation above our 8% upper band. So yes, in fact, from second quarter of this year, it has been almost the entire 9 months of this year so far above our upper band of 8%. Our projection is that this quarter, the fourth quarter, is going to be around 6%. It started going down. So the food, in fact, we had expected it to start going down in the third quarter of this year. If you remember, in our press release of I think the repo, we had expected to start going down in the third quarter, but then we had this transport fare hike because of the social distancing of COVID. So that played a part in keeping the inflation high. Now, after the revision of the transport fare, it's now played positively into the inflation numbers. Already we had 7.2 for October, and we expect the average for this quarter to be around 6%. And for next year, we expect it to go even around 5%, which is our benchmark, medium-term benchmark. So yes, we've had it high, but going forward, we expect positive developments around inflation.
Yeah, that in a way also has had an effect on the franc in terms of depreciation. Going to the forex bureaus, you have the franc almost at 1,000 Rwandan francs to the dollar. Looking back 3 years ago, this was 700 Rwandan francs, an increase of about 300 Rwandan francs. Now, that's good news for some of the landlords, but not very good news for most of the traders.
I don't think it's good news for the landlords as well, because they expected to be charging their rent in Rwanda. Some misbehave and want to charge it in dollars, yeah. But any economic actor in Rwanda, you expected to be transacting in the Rwandan franc. So coming back to your question, it's not really directly linked inflation and the depreciation. To the contrary, if the depreciation is high, it will transfer into inflation. It will lead to inflationary pressures. But this year, or this second half of this year, we expected to see pressure on the Rwanda, because as the economy is opening up, the demand for imports grows up quickly compared to the resumption of export revenues. So we generally speaking, our economy has had a trade deficit for quite some time, and that is normal with an economy that has no natural resources and it's growing at high speed. So the demand of imports is always high because of the need for materials into investment, into construction, into industry, capital goods importation. Also, as people start getting money, their consumption patterns change and they start demanding things that are not produced locally. So that creates quick growth in the import bill compared to the now the investment needed to grow the export revenues. So, but this year is worsened by COVID. Because of COVID, our traditional export prices have gone down. The commodity prices globally have gone down, and therefore that has affected our import revenues for coffee, tea, and minerals. But I think our biggest problem has been with tourism. Tourism had become one of our biggest foreign exchange earner, and because of COVID, that has, I think, the most hit sector globally. And so that has created less inflows of foreign exchange, and therefore the inflow and the demand of foreign exchange, the gap has even widened. So we expected that, and the pressures on the currency today was really expected. In fact, we had projected the currency to depreciate at around 6% of slightly above that. Where we are today at 4, I think yesterday we were at 4.73. So we might not hit the 6% as had been projected. But yeah, so I would say it's always to say that it's normal economic fundamentals driving this to somebody who thinks he's being hit. But as I've been telling people, it's why we had to intervene more this year, because the shortage was more pronounced than we've had before. Normally we intervene at around $4 to $5 million per week. But this, starting October, we had to increase this to around $15 million per week.
Is that
3 times.
3 times?
Yes. And this was, of course, supported by good inflows government received from the development partners to deal with the COVID. So we are using this way to deal with these challenges of COVID. And we expect that by next year, we should have started recovery on the export side and the tourism side. So we don't need. So this is a short-term measure that is really to, one, provide the much needed foreign exchange for import of necessary goods and services. And so, yes, there is pressure. It was expected. What we are doing is to avoid any speculative tendencies to kick in, and that's our duty as the central bank. Otherwise, the price will be determined by the market.
Talking about short-term measures, one of those that was set up was the Economic Recovery Fund. And there's been disruptions here and there regarding either lack of information on how to deal with, on how to access it, or a fear for it, or a fear of it. Uptake has been low. What can be done to ensure that the businesses that actually need it to survive, because if they don't get this fund, many may not survive, and we are largely dependent on SMEs in order to ensure our economy bounces back, are able to access this funding?
Yeah, I know, and that's true. We've had, when the fund was being set up, we expected the demand would overwhelm us, because we expected the amount wasn't that big, $100 million. We expected to receive much bigger demand immediately. So we had the window on hotel refinancing. That was, of course, used up. It was easy. It was restructuring the loans they had in banks. And so today we've restructured and paid up an amount of around $43 million, 43 billion for Rwanda. So that is done and closed. Now on the working capital, yes, there has been slow uptake. The banks themselves were not, I think, ready and positioned to support those that needed this amount. So in the last 2 weeks, we've engaged with banks, Means for Finance, ourselves, RDB, we've engaged with the banks and agreed to set up special teams to deal with these demands of this fund. So we hope that will expedite the transactions or the turnaround of the demand for these particular loans. Then, again, through the committee chaired by the Minister of Finance, we are looking at other ways. Do we need to adjust on the criteria? To understand better the challenges that people face that limit their access to this fund. So it's a continuous process, and I think we agreed to be meeting, I think, in a week's time again to see if there are any changes we need to make. Yeah, but our target was that by the end of this year, we should have had a bigger consumption of this portion of the working capital.
license when it comes to this situation, especially being,
but we expect those really need to be pushing to access the money. And
but
so
they fear that
there
may be catch-22s here.
That's true. We've had cases of some business people saying we're already indebted, and if we add this fund, well, it's very cheap in terms of the interest rate, but still it's a loan on top of another loan. So maybe we're also looking at what that means. But the fact is, this is taxpayers' money. Government is borrowing it, in fact, from outside to finance this. It's difficult to just give it in as free money to the beneficiaries. So there has to be some minimum conditions, like for the hotels was given at 5%. That's almost free money.
5% is still on the upside, especially when you look at young people talking about things like mortgages, where we still stand at quite some rates. And great you brought up the issue of the commercial banks playing ball when it comes to this. Commercial banks haven't been playing ball when it comes to the key repo rates. How do we ensure that if I'm going out to the bank and the central bank has it at 4.5%, at least I can get a 6% from from the commercial bank? Because it doesn't help the layman if it's 4.5% and the best deal they can get out there is an 11 or 12%.
No, I think we've tried to explain this. Maybe let me try to explain it again. The link between the central bank rate and the lending rate by the commercial banks. So, as I said, the central bank rate is an indicative rate that impacts immediately on the short-term money market rate. That is mainly the interbank rate. But when you go to the lending rate, so people confuse this rate as if banks borrow from us at 4.5 and extend the loans to them at 16%. Banks don't borrow from us at all for lending on lending to their customers. Banks borrow from us what we call reverse repo for short-term liquidity management purposes. But the money they use mainly on lending to their customers is money they borrow from depositors. And average deposit rate is always around 8-9%. So that is their first point of departure. So their cost of financing is around 9%. Add their operational costs, because if they have to lend you, they have to run a bank, and that is expensive. Add the risk factor. So there are many factors put into this pricing that they give to their customers that determines where the rate will be. But as I said, as we kept on bringing down the key repo rate or the central bank rate, the lending rate has also gone down, though a bit more sticky, because when you look at where we were at 2017 at 17.5, last year I think we had an average of 16.14, so already it has gone down. So it's not like we reduce 0.5 and we expect the banks to reduce 0.5. No, there are many factors that play into the interest rate of the banks, and so it's mainly, and what we've been telling people is, if they were good customers and they're paying back their loans, at least the costs, the credit risk cost would go down, and that attracts the banks to reduce also on their. But if the banks are still having to do big provisions for bad debts and write-offs, of course that has to come back into the interest rate as part of the cost, but also as a part of the risk factor they are providing for. The good thing is, despite the first 9 months of this year that inflation has been high, our inflation, generally speaking, is always low. And that's not a big factor into their pricing. So it's mainly about the cost of their financing, the operational cost, and then the credit risk.
What role can a credit bureau do in helping ensure that the credit risk is not as high and banks can go ahead, commercial banks can go ahead to lower these lending rates?
I think what the Credit Bureau does, and that's what we've been trying to educate people to understand the benefits of the Credit Reference Bureau, you build your credit history. When you build your credit history and you are a reliable borrower, then the banks will give you preferential rates, will give you at good rates. Your risk factor is very small. And so as borrowers pick interest in building a healthy credit risk, they'll be careful not to default on their loans. And as they are being careful not to default on their loans, of course, to be reducing the credit risk. Again, the banks, it's a culture that is repicking, which wasn't the case before. The banks are not really referring to your credit rating in the CRB, and so you, a good borrower and somebody who is a defaulter, maybe has defaulted here and there, would end up with more or less the same rate. So, but if the banks start rewarding the good borrowers with less interest rates vis-a-vis those that don't have a healthy credit history, that attracts people to keep a credit history that is healthy, that will allow them to get cheaper loans from banks. So it's not really playing out as expected, but that's what we expect to see in the near future.
How do we accelerate this, especially for people in the informal sector?
Education. I think it's really education. We've been saying this. If you've listened to us in the monetary policy and financial stability statements, we always encourage people to check on their credit ratings before they go to borrow. Use your credit rating to negotiate a good interest rate. So it's really, the ball is more in the borrower's court than even the banks.
Let's talk about sectors regarding this MPC report released. Sectors that predominantly were performing well, some that bounced back. Construction sector is one of those that has seemed to pick up. Now, is this pickup as a result of the lockdowns that happened and the measures that happened before, or is it something that we expect to be sustainable for the short term, 2 to 3 years?
And incidentally, our economy is not very big. So when there's one big project, it always has a positive impact on construction. So like last year, 2019, we had, I think, 2 big projects, the Kigali Arena and the PIT project in Southern Province. They played a big part in the growth in the construction sector. This last 6 months, I think the biggest driver has been the construction of schools across the country. And so we normally expect to see what we would call anchor projects in construction that drives this sector. So it's mainly around big projects. If like in 2017, I think, when the 2 big hotels were completed in 2016, we saw a drop in 2017 on construction because we had had this big drive from 2 big projects. So it's really linked to bigger projects coming up in the pipeline. The good thing, if things resume, we had many in the pipeline, so they should be able to drive the sector.
And as we round up these financial instruments, T-bills and bonds, the central bank has been providing over this year, what has been the performance? Has it been above expectations for you for the year, or has it been heavily impacted by the pandemic?
And it has been above expectations, and maybe one would, but nothing unusual compared to what we had in the last years. So the T-bonds, we've had oversubscriptions of always above 150% of the ticket amount. So I wouldn't say it's beyond expectations, because it's some investors would see it as a safe haven to invest in. And also the banks, now that the demand for loans had gone down, of course they'll be happy to invest in the government securities. So we've seen both short-term and long-term government securities attracting big investments. And so nothing unusual really has happened.
How can the economy, especially Rwanda with the coming up of things like the Kigali International Finance Center, use this performance of the T-bills and bonds to attract investment on a sustainable financing model to the country?
I think what this does is really build the Rwanda Stock Exchange. It's creating a yield curve for the interest rate, so at least it acts as reference products on the market. So whoever wants to issue a debt on the stock exchange, at least you have this government reference. So the more, if you remember 2 years ago, I think we started doing the reopening of the bonds, really creating benchmark bonds that could help any investor wanting to invest use through this channel of borrowing through the capital market. So it's helping to build the capital market as a reliable source of financing for long-term investment. And that's what government is, beyond just mobilizing financing from the capital market, is creating and building the capital market to act as a source of financing long-term investment in our country.
The country has been growing in double-digit figures over the past years. That would be more than a miracle if it ever happened this year or the next. When should we expect Rwanda's economy to bounce back to previous heights?
The projections we had from the Minister of Finance was 2023-24. I think that's when we expect to see the growth coming back to around 8%.
And looking at global economic projections, we're not really tied into the global market as much, but in your estimation, when should the global market expect to go back to normal, being that now vaccines seem to have been discovered?
Yeah, I think all has been sounded by uncertainties of what happens with the pandemic. Now that we see that light at the end of the tunnel with the vaccines, I don't know how soon this will be deployed across the world, because it won't be enough if to just deploy it in the Western world. But the projections were that next year we expect the global economy to rebound with positive growth. And also, I think it was expected that by 2025, so that's when we expect to see the normal growth trend that we're used to.
And what sectors do you think Rwanda will be banking on?
Agriculture remains key, and I think there's a lot of work being done, I know, by the government to really drive the manufacturing. So I think these two will remain key, and these also now feed into the service industry. Service industry remains, remains a key driver to our development. But if these two work as expected, they will really drive the service sector as well.
Thank you, Governor.
Thank you.
That was the Governor of the Central Bank of Rwanda, Mr. John Rwangombwa, speaking to us all matters finance and what happened in Q3. A few projections, a bit tight-lipped on what he expects next year from Rwanda's performance. But as always, you can be part of this conversation. At CNBC Africa is our Twitter handle. At The Real Quizera is my Twitter handle. Have a great rest of your day.